Hello everyone, and welcome back to Dr. Tao's Quant Lab. Today we are looking at subsection 1.7.3. In the last video, we found the earnings per share, EPS. Today, we are going to take that EPS and translate it into a mathematically sound, actionable price range. A high EPS is fantastic, but it does not mean the stock is an automatic buy if the price is simply too high. To link a company's earnings directly to its stock price, we use the price to earnings ratio, or PE. This metric measures exactly how much investors are willing to pay for every single dollar of a company's earnings. Before we calculate anything, we have to ask, what is a good PE ratio? The answer depends entirely on the sector, because different industries grow at different speeds. Take a look at the typical PE ranges table in your notes. A mature, slow-growing utility or financial institution might trade at a low multiple of 10 to 15. On the other hand, a magnificent 7 or mega tech company with a massive monopoly and high expected growth might easily command a premium multiplier of 30 to 45 or even higher. You must always compare a stock's PE to its specific sector baseline. Because EPS is the denominator in our formula, the time frame of the EPS you use changes everything. There are three main variations you need to know. First is the static PE. This uses the EPS from the last completed fiscal year. Number two is the trailing PE, or TTM. This uses the EPS from the last 12 months, the last 4 quarters. It is factual and verified, but it is backward looking. Number three is the forward PE. This uses the forecasted EPS for the upcoming year. This is what Wall Street actually carries out because it prices in future growth. Let's look at the example in your notes to see exactly how this works in practice. Suppose a stock is trading at $120 right now. In the middle of year 2, first, we calculate our 3 different EPS values from the quarterly data. The static EPS is just the sum of year 1, which gives us $4. The trailing EPS is the sum of the last 4 quarters reported, which gives us $5. The forward EPS looks ahead to the end of year 2, taking our reported numbers and adding the analyst's estimates. This gives us $6. Now, watch what happens when we calculate the PE ratios using that exact same $120 stock price. 120 divided by 4 gives us a static PE of 30. 120 divided by 5 gives us a trailing PE of 24, and 120 divided by 6 gives us a forward PE of 20. If you only look at the static past, the stock looks expensive with a 13 multiple, but Wall Street prices in the expected growth, which is why the forward PE shows the stock is actually trading at a much cheaper 20 multiple. Notice now the static PE relies on data that is already 6 months out of date. Because the stock market is a forward-looking discounting mechanism, relying on static EPS will almost always give you an inaccurate valuation. So, moving forward in this course, and in all of our real-world examples, we are going to completely throw out the static PE. To estimate a reasonable price range for stock, we algebraically rearrange the PE formula. Price equals PE multiplied by EPS. To get the most actionable valuation, professional analysts calculate two distinct price ranges to map out both risk and reward. Range 1 is the deep value floor. This is your risk management. We multiply the factual trading EPS by conservative sector multiple, like 20 to 30. If the market panics or growth stalls, this is the lowest price. The stock should fundamentally fall to. Range 2 is the expected target. This is your reward. We multiply the estimated forward EPS by a premium historical multiple, like 30 to 40. This tells you where the stock should go if the company executes perfectly. Now, how do we predict that forward EPS? We rely on three primary sources: management guidelines during earnings calls, analysis consensus estimates, which you can find for free on Yahoo Finance, and historical growth averages. Before we move on, I want to give a quick quant tip. For financial summary tables, EPS is almost always rounded to the nearest penny. This is perfectly fine for finding a fundamental valuation range. However, if you are building high precision algorithmic models, you can calculate the exact unrounded EPS yourself by dividing the exact net income by the exact diluted share count found on the full income statement. Now, here is the most important lesson of this chapter. Fundamentals are not static. You do not calculate this once and go to sleep for a year. You must recalculate your fundamental ranges every 90 days as new quarterly earnings are released. Let's look at the ultimate proof of how this works by tracking NVIDIA quarter by quarter across fiscal year 2026. Part 1, May 2025. In April 2025, the US restricted NVIDIA's exports to China, resulting in a massive 4.5 billion charge. Let's calculate the fundamental range at the exact moment of fear. The trading EPS was $3.1. Assuming the China loss would stall growth, we conservatively modeled a flat forward EPS of $3.1 as well. Using a conservative multiple of 20 to 30, where deep value floor was 62 to 93. Using our table's premium megatech multiple of 30 to 40, our expected target was 93 to 124. Now look at the chart. During a peak fear in May, the stock bottomed at 110.82, Notice how it never broke or deep value floor. It found support securely inside our expected target band. Portfolio value investors were aggressively buying the dip. Part 2 and Part 3. In August and November, NVIDIA releases its Q2 and Q3 reports. The business was highly resilient. EPS grew to 1.08 and then 1.30. As the trailing EPS grew, our expected target range expanded aggressively upward. But look at what happened in October. The stock spiked to an all-time high of $212.19. If you look at the math for Q3, the absolute selling of our expected target was $193. The stock has significantly overextended beyond its premium valuation. It was priced beyond perfection, and so it immediately suffered a mean reversion pullback, like this. That brings us to the Q4 reality check. NVIDIA just released a massive $1.76 EPS for Q4. As you can see in the table, the new factual trailing EPS for the full year is exactly 4.90. Now, we have to estimate the forward EPS. If you look at NVIDIA's recent history, their year-over-year growth often exceeded 60%. So why on earth are we artificially dropping our forward estimate to just 20% here? This is a crucial lesson in risk management. First, we have the law of large numbers. It is mathematically and physically grueling for a multi-trillion dollar company to maintain 60% growth forever. Second, we must build in a margin of safety. If we model 20% growth and they deliver 40%, our valuation is safe, and we capture the upside surprise. If we model 60% growth and they only deliver 40%, our entire model collapses and the stock crashes. Therefore, we conservatively model a 20% forward growth rate, giving us a new forward EPS of $5.88. Let's build our two definitive Q4 ranges. Our deep value floor, trailing EPS, times 20 to 30 is now 98 to 147. Our expected target, forward EPS, times 30 to 40 is now 176 to $235. Look at the incredible shift. In less than a year, the fundamental reality of the company put the expected target up by over $80, simply because the business generated more cash. Look at the chart for February today. After pulling back from its overextension, the stock is currently trading right near the $177 level. It is setting perfectly at the bottom boundary if its new Q4 expected target range of $176. By updating this math every single quarter, we have established a highly logical, mathematically backed value entry. Okay, Thank you for watching, and I will see you in the next video.